Hello and welcome to Market Domination. I'm Josh Lipton alongside Madison Mills, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
This is going to take time no matter what. I mean, we're in a second phase, the second part of the trial. The court has already found that Google's a monopolist and did some things that they thought were anti-competitive. Now the second stage is the remedies phase. What kind of remedy will address those kinds of harms that the court found in the first part?
So because there's all these conflicting elements, we think we will get a bumpy landing. We will have a slowdown, and it will probably be some volatility in this market. So I think that's going to be a better option or a better outlook as to what's happening versus anticipating a soft landing.
I think the big picture is sort of a near-term blip, and in the long term, there's a decade plus of backlog for commercial aircraft demand for the two OEMs, and Boeing is one of the two. And there's just a lot of secular tailwinds for the industry. So I think in the long term, this is not going to be meaningful.
We're an hour until the market closed. Let's take a look at our major averages here. Lots of green on your screen. The Dow up, the Nasdaq up 0.4%, the S&P 500 up 0.5% here. But I do want to check on how Nvidia is doing today, Josh. We've all been watching this stock today. You can see heading into the close down about 0.3%.
Yeah, but a nice run. I mean, it has been a focus in making headlines. I think a lot of the attention there, Madison, as we know, is on that new platform, Blackwell. And when NVIDIA executives have been talking recently, they've been sounding bullish, sounding confident, and that's obviously helping sentiment.
It certainly is. I also want to pull up the Treasuries board if we have it right here. I want to pull up the 10-year specifically, continuing it to see a rally in yields as prices coming down, perhaps a little bit on the heels of those Fed meeting minutes. We're also seeing the dollar up as well. So not really seeing signs of economic weakness to come in this market.
Yeah, in terms of bonds, by the way, you have a very smart bond guru coming up later in the show. So good advice coming for fixed income investors.
Very good advice, especially getting some retail investor advice from that conversation as well. But for more on the minutes from the Fed September meeting, we're going to bring in Yahoo Finance's Jennifer Schomburger for the latest. Hey, Jennifer.
Hey, Madison. Looks like Fed officials had a lively debate about whether to cut by 25 or 50 basis points last policy meeting, according to minutes that are released with a 3-week lag. A, quote, substantial majority of Fed officials supported lowering rates by 50 basis points last meeting, but, quote, some would have preferred to have lowered by smaller increments of 25 basis points. According to those minutes, those who wanted 25 basis points noted that inflation is still somewhat elevated, while economic growth remains strong and unemployment low. Several said that by going by 25, it would line up more with a gradual reduction in the policy rate that would be more predictable and allow more time to assess the impact on the economy and what's needed. Now, for those who preferred the jumbo cut move, they said it would help sustain strength in the economy and the job market while continuing to bring down inflation. Adding to that, some said there had been a case for a 25 basis point rate cut at the previous meeting in July. Remember, we know that several officials were ready to cut rates by 25 basis points at that meeting, and that data on inflation in the job market offered more evidence that inflation continues to drop while the labor market continues to cool. Now, some also worried that cutting rates too little or too late could risk weakening the economy and the job market. We know Austin Goolsbee is one of those folks. And a few noted that the costs of trying to address a weak labor market once it's underway becomes quite difficult. Now, officials also wanted to communicate that by cutting by 50 basis points, they are not signaling that they see a souring economic outlook. They also wanted to note that by going by 50 basis points, that doesn't signal that they're going to go in that same magnitude going forward, that they're not going to go rapidly. Rather, attention should be paid to the policy path that has already been laid out, which we know is for 2 more 25 basis point rate cuts. That is the consensus, though. That was also a close call last meeting. Guys?
All right. Thank you, Jennifer. For more on the minutes from the Fed's September meeting, let's now welcome in Brett Ryan, Deutsche Bank Securities Senior U.S. Economist. Brett, it's always good to see you. So as Jennifer was just noting there, it seems like we did have a lively debate, a healthy debate here, Brett. Some officials, it sounded like, would have preferred a smaller size cut, thought that would have made more sense in terms of just kind of a gradual path, a gradual trajectory of easing. But obviously, you know, a substantial majority, it sounds like, did want that outsized cut. What do you make it of all, Brett?
Yeah, thanks, Josh, and Jennifer did a good job of summarizing. One thing I would add to that is that to the chorus of those that were arguing for the 25 basis points, there was some concern about over-easing of financial conditions, and that potentially doing some damage to the trajectory for inflation. So it was definitely a healthy debate. It appears that, 25 basis points was mentioned 4 times in the participant discussion versus 50 basis points once, outside of the substantial majority. So it does speak to, I think, the committee's desire going forward, absent a substantial shock, that they're going to be moving at 25 basis points, for the next several meetings. Right now, the Fed funds futures curve is almost exactly in line with our forecast, where we expect 25 basis points at every meeting through March, and then switching to a quarterly pace, settling in at 3.375 by September of next year. But also note one of the points made during that discussion was that it's the destination that matters ultimately, and when you're uncertain about that destination and how restrictive you may be in an environment of still elevated inflation with some upside risk still remaining, that it's best to go at a gradual pace, as they typically have done. So that makes sense in our view. And, the data are going to be messy over the next month or so with the unfortunate weather impacts of the hurricanes. So I think the Fed's going to want to keep a steady course.
We'll talk about the read-through of those idiosyncratic events in a second here, Brett, but I'm curious, could we get a no-cut November?
I don't think that's necessarily on the table. I think you need a large upside surprise in inflation tomorrow, which, it doesn't look likely to happen. We're expecting about a 30 basis points on core CPI. You would need to get something double that, I think, for the committee to really question something. The labor market data that we got, and that's one of the reasons why the minutes are a little bit stale, is that this was before the strong jobs report last Friday. Now, the jobs report last Friday doesn't necessarily speak to a reacceleration of the labor market. It more eases concerns about weakness over the prior couple of months. It basically was a bit of a rebound. And when you smooth through that, you get the story of, yes, it's still a cooling labor market, but there isn't any further deterioration in the labor market. And that was what the main benchmark was for Chair Powell with respect to further 50 basis point rate cuts. But we're not at the point of discussing whether or not they're actually going at all. I think you need another, a few more really strong employment reports for the committee to question the level of restrictiveness.
Brett, CPI is on deck. Curious to hear expectations there. And what does sort of the longer-term trajectory of inflation look like to you, Brett?
Yeah, so as I said, we expect 30 basis points tomorrow, around 30 basis, but a little bit less than 30 basis points actually on core CPI tomorrow. And the trajectory is still largely the same. You do have some upside risk from energy prices if they stay elevated, but we expect core PCE to get down to around 2.2% next year, and 2% in 2026. So still a glide path down, and that's assumes the Fed is still modestly restrictive in the near term, and then eventually getting back to a neutral stance of between 3.25% and 3.5% by September of next year.
And going back to what we were talking about a little bit earlier, as an economist, how are you thinking about the potential impact of Hurricane Milton and also the strikes? Obviously the port strike is on pause for now, but we have the Boeing strike as well. Talk to us about how we should be thinking about how those events could impact the labor market moving forward.
Yeah, it's going to make the labor market data look like a mess. We expect the claims to spike from Helene to show up this week in the claims data. We're expecting initial claims to jump to around 240. You're going to see a further increase on the back of that in next week's data, and the next several weeks probably, because of the impact of the unfortunate, very strong storm that is Milton now. And it's going to feed through to a variety of data. Regional PMIs, such as the Richmond Fed, could be impacted. Industrial production, because you're shutting in Gulf of Mexico oil production at the same time. And, this could impact the GDP data to some extent. Now, on the flip side, what you could also see is you'll see a dip in some things, but a surge in other things. So, for example, like retail sales, you'll see auto sales plunge, but then rebound really strongly once the insurance checks start going out and people purchase new cars that have been damaged in the hurricane. And the same thing goes with construction. You'll see construction dip and then surge over the following months as rebuilding efforts get underway, because after all, you're going to have FEMA money going in. So it is in near term, it muddies the waters for the Fed. And the most prudent course is probably to pre-signal ahead of the November 7 meeting, because the employment report for October that's going to be released during the blackout period, November 1, is going to have a lot of noise in it, as most likely the Boeing strike. And again, you're not going to be able to really know for certain what the drag on employment could have been from the hurricane disruptions. So from the Fed's perspective, it's probably best to pre-signal this one and not leave it as open-ended as they did at the last meeting.
I'm curious, Brett, we're heading into earnings season here, and there's going to be a tremendous amount of tension. Everyone will be slicing and dicing earnings reports and conference calls, trying to get a read on the state of the consumer. We know the lower income consumer, Brett, has been under pressure. You'll hear executives talk about, a discerning, a selective consumer. Is that still the case, Brett? And any signs in the data that those pressures have moved up the socioeconomic ladder in any way?
No, I mean, the Fed mentioned that in the minutes today. And what I like to tell people is that the tale of the two consumers is a tale as old as time. The top 20% account for 40% of consumer spending. And, as long as the labor market is not showing a substantial pickup in layoffs, yes, hiring is not necessarily strong and wage growth has come down, but income is still coming. And until you get a significant hit to income or something that spooks that top 20% into pulling back on spending, perhaps maybe a drop in asset prices, which doesn't look likely at the moment, things look okay. And it looks like a soft landing. I would also add, people are going to be focused on the election too coming up.
Brett, it's always good to have you on the show. Thank you for joining us, sir. Pleasure
as always, Josh. Thank you.
We are just getting started here on Market Domination. Coming up is a breakup coming for Google. The DOJ has proposed several moves that could break up segments of Google's search business. I'm going to speak to an expert on the other side. Plus, cruise liners are sailing higher on the back of a bullish analyst note. Our top calls of the day later in the hour.
And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned. We've got much more market domination still to come. Department of Justice saying in a new court filing that it may recommend breaking up Google's search business. For more on what to expect, we are joined by Harry First. He's a professor of law at New York University, also part of New York State's Department of Justice. During the Microsoft?
Some years ago, yes.
Okay, some years ago.
We pretend Microsoft was just yesterday, but it wasn't yet.
Just during the early 2000s. Right. So a fantastic guest to have on this because you were there really at the forefront of the last big regulatory push against big tech, which was with Microsoft. What similarities do you see today with Google?
Actually, the plaintiffs in the case, and we have to remember it is the Justice Department and many states. Mm-hmm. So it's not just the Department of Justice, but the plaintiffs have actually based their case around the law in Microsoft and have brought this case as a maintenance of monopoly case, just like they did in Microsoft, an effort by the dominant firm to maintain its position by engaging in various kinds of exclusionary behavior to keep out the competitors. So.
Do you think, bottom line, correct me if I'm wrong, but the agencies can't order a breakup. So what is the likelihood, in your opinion, that a judge really, at the end of the day here, is going to order a breakup of Google? What odds would you actually give that?
So are we doing betting markets now?
Yes, absolutely.
Yes. So I think the odds are, is medium a word for the odds?
Sure.
The odds are medium. So there are several hurdles. First is the district court judge who tried the case himself. Very careful judge, Judge Mehta, very thoughtful judge. He may consider a breakup, but first, the government plaintiffs have to actually ask for one, and it's not clear from their current filing, which is just a remedies framework. We're not going to tell you what we're asking for. So it's not clear they're going to ask for it or how. So first, they've got to ask. Second, the judge has to agree. Judges tend to be conservative, and they're not looking to make tremendous waves.
That would be a big wave.
Yes,
yeah.
They don't view themselves as industrial organization economists. They're judges. So the judge will be cautious, as the judge in a related case that Epic has brought against Google was careful. And he said he doesn't want to be too interventionist. So that's the first hurdle. But the law would allow the judge, if the judge can support the decision, to impose whatever remedies are necessary to unfetter the market, is the language, to restore competition. So that's the first hurdle. But then the second hurdle is the judge has to convince a court of appeals to do that. And the other parallel to Microsoft is that in the Microsoft case initially, the judge had ordered a breakup of Microsoft, stayed the remedy. And for a number of different reasons, the Court of Appeals threw that remedy out, but also indicated that it was not anxious to do this. You really had to have a lot of support, a lot of causation connection between what the defendant did and the maintenance of monopoly, and that this would be a remedy, the language was tailored to fit the wrong. So courts of appeals, the Court of Appeals, particularly in the DC Circuit where the case was tried, have been sort of conservative towards remedies. The remedy that was ultimately chosen in Microsoft was done by agreement, by negotiation. This one so far is not. So that's another aspect to how a Court of Appeals might look at the case.
And now there's this question about whether or not this is going to be applicable to other big tech firms. What was the big red flag from Google that other tech executives who are all tuning into this conversation should be keeping an eye out for?
Compete on the merits and don't engage in exclusionary behavior. How's that for, antitrust lawyers love that language because then they can be called in to advise the clients as to exactly what might be considered exclusionary, and some things to look for. In this case in particular, you're sort of paying off your competitor to not develop the competing product.
Explain.
So Apple got huge payments for making Google search the default on mobile on the through the iOS. So why did they get so much money for that? So one of the economic answers is you're being paid not to enter. We're going to sort of split these profits with you. So you have to watch for those sorts of payments that get exclusivity. Yeah. And that would be one thing to look for. So you want to look for exclusive agreements that box out the competitors. The favorite language today is create a moat around the monopoly, and that's what you would look for. First condition is that there be that you have a monopoly in a relevant market, of course.
Let me ask you, Harry, so we have an election just weeks out now, right?
Do we have? I'm sorry, I missed that.
I don't know if you've heard.
I've been watching the antitrust cases. Yeah, go ahead.
Right. Let's say, I'm curious on this. Let's say Trump, Vance take the White House. Right. And Jonathan Cantor, Lena Khan are out of work. I mean, who knows, because actually Senator Vance has nice things to say about Lena Khan. But let's say they're out of work. How, if at all, would that impact this case?
So this is a question I'm sure all the lawyers in the case are asking themselves. And again, we have the parallel in Microsoft because that is what happened. There was a change of administration. So I don't have a particularly good answer. There's a range of possibilities. One possibility is that there's some sort of settlement. I think that the most likely thing is the lawyers who are trying this case, and it's not Jonathan Cantor, and in the FTC cases, it's not Lena Khan or the commissioners, that the staff that's trying the case will continue, but at some point there'll be new leadership appointed, and they will want to put their own stamp on it. And I think this will be true whoever wins. I think there's always some change at the top. So they may have some different views or they may not. Hard to predict from the party, given, as you said, J.D. Vance's position. Who knows if anyone will listen to him if he becomes vice president. I mean, who knows?
And Trump kicked it off in the first time he was in the White House as well, so that's also
well, remember, this case was filed in the Trump administration.
Exactly.
But a very different attorney general. Yes. So
a lot of variables, Harry.
A lot of variables.
All right, Harry, we got to leave it there, but really appreciate you joining us. And we know you're in the neighborhood, so we'll be calling you again. Thanks you so much. Appreciate it. It's now time for some of today's trending tickers. You can scan the QR code on your screen to check out the best and worst performing stocks of the day on Yahoo Finance's trending tickers page. Let's kick it off with KinderCare. Shares of the child care provider rising after its public debut on the New York Stock Exchange. And it's interesting here because this is actually the second time that KinderCare has attempted to IPO. It postponed its listing plans back in 2021 amid regulatory delays, but now they are back in action here. You're seeing shares up nearly 10%, trading just above $26 a share. That is near the top of the marketed range as well, which was $23 to $27 a share. So certainly seeing a lift there. And just as a reminder, KinderCare is the largest private provider of community-based early childhood education. Josh. Yeah, makes its debut, raises $576 million. Apparently plans to use the proceeds to repay $548 million of loans, cover another about $7 million worth of expenses. Just looking at the financials, net income $103 million on revenue of $2.5 billion in 2023. There's a lot of talk, just more broadly, Madison, about how 2024 we would see this bounce back in IPOs, and you have seen a pop year over year, though of course way down from where we were pre-pandemic. I'm excited. It's fun. Yeah, you got to be in the business a long time to say you're excited. I like that. Well, I've only been covering markets during the IPO drought, so for me... Oh, this is a whole new chapter. Who knows what's going to happen? Exactly. Switching to tech, shares of Astera Labs jump in today's trade after debuting new switches that are purpose-built for AI infrastructure. So nice move in today's trade. Look at that, up about 14%. Semiconductor connectivity company, new portfolio of switches was announced. Purpose-built for AI workloads. I saw Morgan Stanley analyst site is saying this is a reason to buy the stock, and they take their target at 74. Yeah, I want to point out, too, just some context here. So they announced a new portfolio of fabric switches. I wanted to know what that meant, so I went on a little bit of digging to confirm. And it's that advanced networking hardware, right? It helps manage flow between different components within an AI system. So, the software, the server, they have to talk to each other, and these fabric switches enable that communication. to be more efficient and more quick. And that is, of course, very important when it comes to AI tests. You want them to be as fast and efficient as possible. That helps with things like cost. So that is one of the reasons that you're seeing the stock soaring today.
Yeah, team at Needham looks this over, says the new product line competes with incumbents like Broadcom. Lots of love on the street by more than 90% of analysts were paid to tell you what to do with this stock, say to buy it.
All right, really good stock rating there for this name. Let's take a look now at shares of Helen of Troy. The stock rising after a stronger than expected second quarter. You can see the shares up 17.5% here. I do want to remind folks that this is a consumer-facing brand. They are selling the likes of Hydro Flask, for example. They've got some hot tools for hair, things like that. Certainly some products that you might see on the makeup desk. Having said that, I want to point out one of the analysts talking about these second quarter results over at Raymond James, saying that the results were less challenged than expected. You can certainly see that reflected in the stock on your screen here over the last 2 days. Just a huge run up there, a little right angle. And Olivia Tong also saying overall the quarter and outlook came in better than feared. And even if pressures continue, still rating the company as market perform, but seeing more upside to come here, Josh.
Yeah, companies talking about, yes, they're acknowledging macro headwinds. Emphasize, though, what they talk about is improved brand fundamentals. They talk about optimized marketing, expanded distribution, says that they expect higher free cash flow in 2025 second half than first half. That's always welcome. The stock is up today, but this has been tough going. It's still down nearly 40% this year, Madison.
Yeah, it's a good point, especially as we take a look at how the consumer is doing in the health of the broader economy. A good stock to look at. Well, we're keeping an eye on the bond market, even as the Dow and S&P 500 on track to close at new highs. Yields are jumping for the 6th day in a row. The 10-year now hovering just above 4% over the last couple of days. For more on this, we're joined by Steve Lapely, BlackRock Global, co-head of bond ETF. Steve, great to have you on here. So I want to focus on what we're seeing in the bond market first, and then we'll get to how that is playing into ETFs, because we're seeing the 10-year above 4% over the last couple of days, even on the heels of these Fed minutes. What does that tell you about how the market is pricing in or pricing out any potential economic weakness moving forward?
Well, Madison, thanks for having me. Yeah, look, there's been quite a lot of debate since that very strong payroll number that came out. There's debate around that number itself, in terms of whether the statistical adjustments will lead to some sort of a revision down the road. But no doubt it was a strong number and alleviated some concerns about, a hard landing scenario. So you've seen the market respond to that. You've seen, the larger cuts get taken out of the market for the rest of the year. Right now, if you look at where futures are trading, you're seeing a couple more 25 basis point cuts, another, around 100 next year. And, for this next cut in November, there's, it's still hovering around an 80% chance, not a 100% chance that you get that 25 basis point cut. The minutes revealed, as your prior guest talked about, some debate around whether 50 or 25 was appropriate. So there's just a lot of chatter in the market. People are really trying to size up exactly where we are and how the Fed's going to respond going forward. I think the important part here is that if you look back a year ago, we were at 5% on 10s. We're at 4 now. It is still not too late in our view to actually move into the bond market. We still have trillions sitting in cash. So it's going to be really hard to finesse this exactly right. But we do think investors should probably, size up their fixed income allocation at these yield levels. If anything, it's an opportunity at this point.
So let me ask you, Steve, when you look at the benchmark 10-year, you are peaking. So 4063, where do you see that heading near intermediate term here?
Well, it's interesting. It's a little bit of deja vu, not at the same level, but we did see some technical pressure last October as well. And I think right now we do have a very big number coming out tomorrow in terms of CPI. We'll see where we are after that. I think that if you get a weak CPI number, you obviously would see a bit of a pullback in these yields. In absence of that, if it's sort of a middling number, I think yields are probably going to be bouncing around here, give or take. There's probably a little bit of technical pressure. There is some, short base that's kind of developing in the market. So you could see it maybe grinding a bit higher. I don't think we're expecting a wholesale jump in yields unless you get a really nasty inflation surprise.
Well, it's interesting because you talked about how investors should size up their fixed income allocation at these yield levels. Is that the case for all investors? And I specifically want to get your take on retail investors because that's a primary part of our audience here at Yahoo Finance. What should they be thinking in terms of positioning within bond ETFs specifically?
Yeah, so we've started to see this. Most of the flows this year, we've seen a record amount of flows this year. We blew past the 2021 number as an industry. At iShares, we just crossed $1 trillion in bond ETFs. Year to date in the U.S., we've taken around $75 billion. Most of that is in broad, high-quality fixed income. So think of the ag, things like that. You then have quite a lot of allocations to treasuries, believe it or not. That's spread around the curve from anywhere from TLT, the longest, all the way down to SGov, which is the T-bill fund. I think the big message here is that investors are still largely underallocated to fixed income. So, the 60-40 is certainly not right for everybody, but if you think of that as just sort of a stalking horse, investors are fairly underallocated to fixed income. Still at this point, a lot of investors are sitting in cash on the sidelines. So, I think at this point, if investors are still a little bit hesitant because of the volatility in yields, we think just at least stepping out of cash into, kind of the intermediate part of the yield curve, there's reasonable value there. Again, think of these kind of belly exposures like the ag or sort of, 5-year treasuries, things of that nature.
Steve, when you talk about these record flows, I'm just curious, we have line of sight where that's coming from. Is that retail, institution, both?
Yeah, I think overall, like longer term, buy and hold flows tend to be more retail. But I do think there has been a healthy amount of institutional flow here. We've seen several stories about large institutional investors using bond ETFs to position. And interestingly, in treasuries, the treasury market is still a fairly liquid market, but more and more we're seeing even pretty large, sophisticated institutional investors using bond ETFs, even in things like treasuries and mortgages to position duration, very tactically as we move in and out of these data cycles, as an example. But yeah, I think it splits. Buy and hold tends to be more retail, but you do see a lot of tactical positioning by institutions using bond ETFs.
Steve, always great to have you on the show. Thank you for joining us.
Thanks for having me.
And coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned, much more market domination still to come. It's a big noise universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. And today we're dialing in on investing maneuvers in an increasingly automated and digitally augmented world. I'm here with Vetify Senior, did I get that right? Vetify Senior Research Analyst, Zeno Mercer. All right, Zeno, great to see you.
Great to see
so
you.
let's start with what you like. Your pick, your first one is going to be Cargo Tech. I promise it's going to come up, Zeno. All right, there it is. Cargo Tech. Let's go through the reasons here. The first bullet you said, automation, AI, and energy convergence. Zeno, walk us through that.
Right. So kind of looking back at the robotic space overall and just physical world automation, not AI, we're talking physical world automation. You're looking at a world that depends on energy as a source of input and output. You have regulation, and there's a lot of moving parts, no pun intended here. And ports are an input for a lot of our major initiatives that the U.S. is focused on now. This is globally too. But as an example, so AI is improving not only the company's abilities to design new products and build better materials and be more efficient overall, but it's also improving the ability for these different coordinated pieces to interact with each other and become more efficient themselves. So right now, putting these all together, we're seeing a huge need. During COVID, we saw a massive issue with ports and labor, labor issues and just a lot of weak links along the chain across the globe. And a lot of times it was the port automation, right? So can you even get things in and out, and whether you're building them there or not, whether it's a finished good or a raw good. And so companies like Cargo Tech are positioned with cargo handling, maritime logistics, forklifts, and all these ingredients that come together to help automate ports and even in construction. So there's a lot of major end markets that they have exposure to.
All right, point number two, you say reshoring and energy transition themes. This is a way to play it.
Yeah, so if you think about reshoring, and there's a couple of ways to play. Overall, robotics has actually had one of its toughest 18 months in history since, for the last 20 years. China was a little bit of a slowdown. In the US and globally, we've had high interest rates, okay? So those alone. And now we also have an election year. And so we're facing kind of this buildup of pent-up demand of like manufacturing and all these things that are ready to go, but they're kind of deciding, who wins, that decides what we're gonna build. So we have had, for the last, I think 16 months, like record high manufacturing and construction. Those have not converted to being built yet. But once all these things start to come online, once we have clarity around those things, we're gonna start seeing a lot more manufacturing in the US. So that's gonna be a lot more port need. Now, so reshoring in energy. On the energy side, one of the major costs of automation is from an operating perspective is energy. So as we're seeing all these investments in like data centers and nuclear, for example, that'll reduce the operating cost of running things using electric and autonomous vehicles, for example, and load shifters and things like that. So ultimately, you've got this massive need. And right now, again, these are very underwhelming. Our top port in the United States, a survey came out, our number one is number 53 in the world, in the US. And so we clearly have a lot of need to reduce this friction point. And this is just one of many. This is one company in one niche area of where robotics can help in manufacturing, logistics. And increasingly, we're going to start seeing those robots go from kind of this behind the scene areas to more out in the open, autonomous vehicles and drones and things that are more interactive, more collaborative with humans. And that's opening up new markets. And we think, all those things are almost a flywheel effect that we're going to be seeing with, again, the convergence of these things and the need to kind of reshore critical semiconductor and other industries here in the U.S.
And Zeno, and a final point here, no surprise you like the name, so you think valuation is attractive?
Yeah, I would say, for the overall robotic space, but especially a company like Cargo Tech, they're trading at 1.3 times forward sales, under 16 times earnings on a forward-looking basis. And really, this is on, I would say, even muted expectations, right? So these are valuations where forecasts from the Wall Street are not really tying in those first 2 points we put together, especially how automation, AI, and energy are going to benefit these things, and then the need we have. So truly overall, we're looking at maybe the bottom of the barrel for valuation in the robotic space. It's relative, like our robotic index, Robo, is at its I think since inception in 2013, it was the world's first robotics index. It's at its lowest relative valuation to the Qs and S&P since inception.
All right, so before you pile in though, What risk should you consider with this one?
Yeah, so the risk, it's almost maybe a hot take to have brought this up, but right now we're looking at an extension of the labor strikes for port automation, and their next stage is saying, hey, we don't want any automation. And I mean, clearly our best port is ranked number 53. We shouldn't really allow ourselves to be kind of kneecapped by a group. Like, yes, they should come to an agreement, and I think they've already gotten a 66% pay increase, but saying no to automation is really not a great idea. I mean, if we did that to everything, we would never advance as an economy, and if we want to reduce inflation and improve operations and be more seamless and resilient, this is just, again, one example of an area. But so this is a risk, but again, it's a global company. It's even based in Europe. So, not expecting no automation to end up being a result, but that is something that is literally on the table and maybe is a contributor to some of those reduced valuations specifically for this company.
Makes sense as those two sides negotiated out. All right, so that was what you liked. Here's what you don't like, which is interesting. Salesforce, not a fan. Let's go through the reasons here. The first one, over-reliance on user-based licensing, you said.
Yeah, so right now, the way Salesforce operates is, it's very hands-on. It takes a lot of work to set up, and that has been a moat for them for many years, right? But the way they work is also primarily license-based on sales teams, number of users, and things like that. And so the way kind of the world's transitioning, we're starting to see more agents, AI agents, if you will, that are helping with sales, customer service, marketing. All these things are, increasingly commoditized in a way. And so while there's been a lot of focus on Salesforce building that out themselves, we're more excited by companies that are part of kind of that physical and digital body, if you will, that tech stack of the future. So this was a company that was in our Think Artificial Intelligence Index, and we dropped it earlier this year.
All right, second area of concern. Yeah, this was interesting because there are bulls on the street, and granted, valuation, eye of the beholders. Sometimes they'll say one of their first points is valuation to them look attractive. You obviously disagree with that.
Yeah, we're maybe valuation is the wrong way to put it. Valuation is based on the current market cap or whatever metric you're looking at over future expectations, and we've just muted our expectations for them. So in our mind, based on our expectations of their future performance and their ability to maintain that growth, that market share, and not lose out to new competitors coming in or some of the other players like HubSpot and others, we just don't see that obvious path to monetization directly in the way that they're operating right now. Like, they're limited to kind of that sales, where there's other companies that are more deeply entrenched in full scope operations and what the whole business is doing. And they're a slice of that, and that slice is at risk.
And the third reason here you would steer clear of Mark Benioff's company, competition from Gen AI solutions.
Yeah, so kind of tying back, I kind of previewed this, but in general, like what we're seeing with the ability to pull together knowledge bases and units across organizations and use that. And increasingly, we're seeing that the level set of those AI, LLMs, whatever type of model they're using, be more attractive for organizations to use. We've already seen, for example, the like telecom and call center industry collapse over the last 2 years, right? But okay, so what is the future of selling to? Are you building a platform for the future of way organizations sell, the way the world operates? Are you selling to be a complex solution? I mean, I don't think anyone sits around and says they love their sales force as they're operating, whether they're a sales agent or an operator. Yes, it's been best in class, but ultimately we see new incumbents, whether it's people have been focused on their Einstein solution, and really what they're building is like other solutions out there that are even broader are able to do that as well. And so we just don't see that upside exactly as clearly as maybe some of the street does.
And then very quickly here, just tell us briefly, how could you be wrong here? What's the upside risk?
Yeah, so if they actually, that last point, if they're able to flip that around and actually become agents themselves, and again, they'd have to compete with other players who are able to do the same thing, right? Because in the end of the day, they're tracking data of an organization, their interaction with customers, that's what they help do. And if another organization or in-house example can just get a database with all these data points and touch points and figure out a way to sell, track, and build go-to-market strategies, like they're going to have to compete. They're not the only ones doing this, and so you can't really depend on this happening. But again, if they're able to lock in and be that direct sales force themselves and help capture some more of that value as the world shifts to more AI-driven sales and relationships between organizations, like that's a way that they could regain, promise in our eyes.
All right, Zeno, thank you so much for your time and those picks. Appreciate it. And thank you so much for watching. Goodbye, goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern. Stay tuned. More market domination still to come.
Between Boeing's manufacturing issues, its ongoing machinist strike, and natural disasters like Hurricanes Helene and Milton, the airline sector is dealing with a slew of headwinds. So where can investors find value? With just a few minutes left to the closing bell on Wall Street, we are looking at how to play airline stocks with the Yahoo Finance playbook. Joining us now, we've got Steve Trent, Citi's managing director. And Steve, it's great to have you in studio with us. I do want to start on those natural disasters, specifically Hurricane Milton, heading towards Florida as we speak. To what extent do you think that could really have a significant impact on some of these airline stocks?
Yeah, and good afternoon, and thank you for having me. Absolutely, on a short-term basis, we could see some impact here. And when we think about the impact of a storm, roughly speaking, rule of thumb, every 1% decline in available seat mile growth translates into a 2% decline in pre-tax earnings, all else equal. So we saw 2 years ago Delta lose 3 pennies per share on the storm that hit Fort Myers. Let's see what happens this time.
Are there certain airlines in your coverage universe, Steve, that are more exposed to Florida than others?
Yes, absolutely.
Yeah.
So the discount airlines, generally speaking, a lot more exposed. The U.S. Big Three have, of course, significant international capillarity, but Florida was the only place open for a number of years after the pandemic hit. So several of the airlines have significant metal in that market. You know, among other factors, Southwest comes to mind, for example, when we think about its exposure to Tampa, but they're not the only one.
You mentioned budget airlines, which made me think about Spirit. And I was just taking a look. It's down 97%, and this is coming on the heels of reports of a potential bankruptcy. How are you contending with a name like Spirit?
Yeah, great question. So I have to be a little bit careful about single stock mentions, but what I will say about the discount airlines, generally speaking, they've had a tough time relative to the network carrier. So we've seen a significant gain in earnings wallet share for the network guys post-pandemic, especially Delta and United. And if you're a discount airline, the market's somewhat moved away in terms of demand. You don't quite have the revenue verticals you need, co-branded card, loyalty, significant premium cabin to really offset the seat mile cost challenges. So you're seeing these groups move into premium, and at the same time they're trying to cut some routes, but it's a tough road. It's a tough road.
Well, JetBlue is sort of trying to do that as well, right? They've got the new lounges, they've got a elusive card that is potentially coming. I know you can't talk specifically about JetBlue, but how do you view that kind of strategy in this environment?
Yeah, absolutely. So I think JetBlue is one of the ones I can speak more freely about. And I think that one, you know, maybe relative to the other discount airlines, they have a little bit more of a track record with the Mint product, for example, and some premium type revenue that they're able to generate. But even then, it's difficult. You know, you have Airbus narrow-body fleet. You've got powder metal alloy contamination issue with the Pratt & Whitney geared turbofan engine. So that's resulting in more aircraft on ground. So at the same time, you've got that seat mile cost pressure. You do not have the same unit revenue strength you do with the network majors, especially the first two I mentioned.
Steve, another issue I want to get your take on, these headlines that talks have broken down between Boeing and the union. I know you don't cover Boeing, so not looking to pin you down on that name specifically, but just your broader take, Steve, on the ripple effects of this across your coverage universe.
Yeah, absolutely. I mean, I think on a longer term basis, there's just, over the next couple of years, very likely to be a paucity of new equipment per capita. So everybody's fleet is going to age. And as a consequence of that, maintenance demand is probably going to intensify. So we'll see possibly some seat mile cost pressure coming from higher maintenance expense, more frequent maintenance expense as the fleets age. And what that means for the folks out there that are shuttling people in passenger planes, this is probably, on a long-term basis, relatively good news for a network airline that can more directly put that scarcity into pricing. And then we think of names on the aircraft lessor side, for instance, that maybe see some market share gains, and AirCap comes to mind. A Fortress Aviation with its very powerful engine module capability. These are the type of names that screen as...
So kind of a mixed bag, actually.
Absolutely.
Yeah.
Absolutely.
And we're also heading into Delta's earnings print. What should investors be watching?
Absolutely. So I think 3Q is pretty much settled as we look into the fourth quarter. Do they reiterate their commentary on looking at sort of the upper end of the full year guide? I know they said that recently, but since they said that, we've had oil move up a bit. So I think some reiteration of that guidance is going to be positive for the market. You know, 2025, maybe it's too early to say anything about that, but we're constructive on the name, and we look forward to what management has to say at their November conference.
All right, Steve, always great to see you. Thank you for coming in.
Pleasure's mine.
While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime. Steve, that was great. As always.
That is your closing bell on Wall Street, and now it's market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's trade. But let's see where the major averages have ended up here. You've got green across your screen. The Nasdaq up just about 0.6%. The S&P 500 up about 0.7%. I also want to point out the VIX here, seeing a little bit of pressure coming off of the VIX, especially if you take a look over the last 5 days. We saw a little bit of movement in the VIX earlier this week off of geopolitical tensions, but we are seeing just a bit of that pressure coming off. And lastly, I want to point out what we're seeing in the Treasury space. Again, not seeing any sort of concerns about economic weakness, at least when you look at Treasuries. Your 10-year is up about 3 basis points, and that is the case across the curve as well when you look at the 30-year yield up about 2 basis points at 4.3. But let's get over to Jared Blickery for a closer look at today's sector action. Hey, Jared.
Thank you, Maddie. Just want to start out with the ICE BofA Move Index. That's a volatility index for the bond market, and that has been hovering over the highest levels since early January. They were just a little bit higher, so that's a continuing development. Nice to see that volatility in some other sectors is going down. I will show you crude oil volatility, which has been elevated. That is now ticking down just a little bit today. And in fact, in this comparison chart of the VIX and crude oil VIX, yes, that actually exists, you can see they're highly correlated, which is often the case with volatility in different instruments. Let's take a look at the sector action as promised here. Tech was a big leader and utilities was the loser here. We have seen the 10-year T-note yield edging higher, and that has typically caused problems for some of the interest rate sectors, but it's interesting not to see energy at the bottom of the heap today. Seems like tech and energy have been trading positions recently. And NVIDIA recording a slight loss here, but it is really close to its record highs. I was kind of relating to that yesterday, and here we can see just more consolidations. If it doesn't make it, probably heading back down to about the 100 level. Let's see what's going on with Apple. Apple trying to break out. This is a record high right here. It's trying to edge up against it in this pennant formation, but still hasn't broken out. So we'll see what becomes of that. Finally, here is our leaders of the day. Regional banks actually in the #1 spot. Then we have software, IGV, I believe just notched another record high. Chip stocks doing well in value. What did the worst? That would be Bitcoin. GBTC down 2% there, Josh.
Thank you, Jared. The Dow and S&P 500 closing at new all-time highs, but one stock not participating in today's rally. That would be NVIDIA. Shares the chip giant edging lower. And this is an example of what our next guest says about this bull market, that it is indeed an everything market. And joining us now is veteran strategist and author of the Paulson Perspective Substack, Jim Paulson. Jim, it is great to have you on the show. Let's just start right there, Jim. You say the stock market here has finally taken on the character of a new bull. It has become, you say, an everything market. What do you mean by that, Jim? Walk us through it.
Well, I think normally when a bull begins, it gets full support from the policy officials, Josh. Usually we're heading into a recession and the Fed starts easing even before a bull starts. They're concerned, and so they ease, and then bond yields go down, the money supply is going up, fiscal stimulus is advancing, the dollar weakens as interest rates come down. In other words, we're giving it the full boat of stimulus, and that's why the beginning of a bull is so fantastic, not only in terms of how much the market rises, but how much its broad participation across a variety of names, everything from defensive stocks to tech stocks to cyclicals, everything goes up at the start. We didn't get that in this bull because the Fed has remained tight in this bull market until about 2 weeks ago. It's the only bull market in post-war history where its entire existence was under a tightening Fed. But now what we have is, like the start of a bull, the Fed's dropped funds rates, bond yields have come down. They've done that. Money supply is accelerating, fiscal juice is expanding, the dollar's coming off a little bit. We're getting a full boat of support, and you're seeing for the first time a broad participatory marketplace where tech is still hanging in there and the old leadership, but you're getting brand new leadership across all sectors, small and large cap, equal weighted than not, cyclicals and smalls, even international stocks starting to partake in this. And I don't know how long that'll last because this is a 2-year-old bull, but I go at younger because the Fed is just now starting to ease.
So how much runway do we have in this bull market?
Well, I think that's a great question, Madison. I I think we still have some fair amount yet. It is 2 years old. I think the average bull's, closer to 4 or 5 years. Also, I think that there's the main thing I look at is the slack in the labor market. And the unemployment rate just went up about, 8, 9, 10%. There's another 1% slack we could employ again and allow us to grow for a while. But in addition to that, I think the labor force usually rises, 5% or more above its previous recovery cycle peak. And we're still only 3% above the previous peak. It'd be one of the lowest recovery endings we've ever had if that happens. But if you put on another 2 percentage points of labor force, 1% lower the unemployment rate, that gives us 3% more in the jobs market. So I think there is quite a bit more room. In addition to that, I just don't see many vulnerabilities. The household and business sector have very clean balance sheets. They haven't overborrowed. They're highly liquid. Money market funds to disposable personal income is close to the only time it's been higher was at the worst of the great financial crisis. I think that confidence among consumers and businesses are still pretty low, still pessimistic. We generally don't end a bull until there's greater optimism that's obvious in the economy and on Wall Street. We haven't seen that yet. So I don't know if I give you exact number, Madison, but I think we're.
Jim, let me ask you about valuation. I'm curious because we've spoken to other strategists. I'm thinking about one in particular, tested veteran, smart guy like yourself, Jim. And he said, I asked him and he said, you know what, I think it's kind of unnerving. That's the word he used, Jim. But you don't sound like you find valuation unnerving here.
I'm losing you here a little bit, Josh, but I think that the problem with valuation is if you go back to the KPE multiple all the way back to 1870 and you look at the valuation range up till 1990, there was a very constant, clear range between about 7 times earnings and 21 times earnings. And it was very clear if we were closer to 20 times, you were an expensive market. If you were below 10, you were a cheap market. But since 1990, valuations have persistently gone higher and they're way outside of the old ranges and have been now for more than 3 decades. The low end of the KPE multiple has basically been the high end of the previous range. I guess what I'm getting at is I think valuation methodologies are kind of broken. And that is unnerving because we're kind of left rudderless as to what's high and low. But I'll tell you, those that have been depending on valuations really since 1990 have not done well because valuation has not worked very well in telling you when to get out or when to get into the marketplace. The efficacy of valuation has decayed mightily from what it used to be prior to 1990. And I think it has a lot of reasons for that. We have less recessions. We have a growthier economy led by tech that has higher PE multiples. We have a more liquid marketplace that's more international than it's ever been. All of those are leading, I think, to a higher valuation range that has still not been fully defined. I mean, at some point we'll come down and part of it will be valuation. But I guess I'd rather look for vulnerabilities in the economy and something like that tells me to lighten up than I would valuation at this point.
All right, Jim Paulson, thanks so much. Appreciate it.
Thanks for having me, man.
Coming up, Piper Sandler saying in a new note that Hurricane Milton could significantly change the insurance market. We'll speak to an analyst on the other side. Stay tuned. More Market Domination Overtime coming up.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
The Biden administration wants feedback on a proposed Medicare. Anj, I'm going to leave it right there.
Yeah, we've got.
Give me more. Hold on. Now, wait. Now I've got it. I got a proposed Medicare payment model that would increase the number of available generic drugs for $2. And joining us now I can welcome you in properly. Yahoo Finance's Anjali Kamlani. Anj.
I could have handled that for you, Josh. Listen, it's been 2 years since we first heard about this proposal from the Biden administration. President Biden passed this executive order asking for lower drugs. Now, what they've proposed is $2 generics. That's a really low number. We've never seen anything like that before, but it is possible. It's one of those things that we have to see what actually ends up coming out of this, what kind of information, where it would be produced, et cetera, what economics go into this $2 production. Now, the list that you are seeing on your screen right now of the diseases are some of the examples that Medicare has already provided with the list of drugs that they sent out that they are hoping to include on this $2 list. So right now, it's just in the proposal process. They're asking for information. They're asking the industry to come together and bring it some real ideas on how to make this a reality.
So how likely is that? And does any of this actually matter in the long term? Will it have the impact they're looking for?
We've seen something like this before. If you remember, Walmart came out a little over a decade ago with $4 generics, and that was the lowest we've really ever seen. Now, are some generics about $2 or less? Yes, absolutely. Some of them are completely covered by insurance, right? So it's really about whether or not they can get a full list down into the system to have $2 across the board without it doing what healthcare always does, which is push up prices in some other aspect. And so that'll be the thing to watch when this starts to come together. And it'll be really interesting to see how the administration goes about it. So we're definitely going to be watching, waiting, seeing what does Medicare do. They're already really attacking between the FTC and Medicare. There's a lot of pressure on the industry right now. This is just another one on the list.
Another one, and something that consumers are also, of course, very interested in and invested in.
Absolutely.
So, Anjali, thank you so much. Appreciate it as always. Well, Piper Sandler's saying in a new note that Hurricane Milton could significantly change the insurance market. The Category 4 storm reaching parts of Florida earlier today. So what does this mean for insurance? For more, we've got the author of that note, Paul Newsome, managing director over at Piper Sandler. Paul, it's great to speak with you. So talk to me about your base case here. What are you anticipating for the insurance market after this hurricane?
Well, I'm mostly anticipating a lot of uncertainty. We don't know what the losses will be. They could be the biggest we've ever seen, theoretically. That could have wide-ranging changing effects on the industry, from pricing, terms and conditions, how things are regulated. So I think right now we just don't know, and won't know for at least a couple of days how important this will be.
Do you believe, Paul, this could lead to kind of broader, I mean, it's possible, depending on the kind of storm we find ourselves dealing with here, could it lead to kind of longer-term structural changes?
It could. Most likely first in the reinsurance markets, which are critical to the Florida market in particular, but also just to how we think about home insurance and other property insurance and who has to take the risk and how it's spread around the world. So absolutely. This could be changing in a very different environment after next week.
So talk to me about what it would take for some of these insurance stocks to start to recover a little bit, Paul, moving forward here. Is it a month from now, 2 months from now? What is the catalyst for that?
Well, they're already starting to recover a little bit because I think the peak fear was probably yesterday, and the industry is designed to handle a large event and spread the losses globally. But the real reduction in uncertainty will happen probably a couple of weeks from now. You first have the storm strike, you'll be able to visually see what the losses are. It usually takes a week or two for the insurers to come out with what they think the losses are per company. And that's usually the trigger for when the stocks rebound, when the uncertainty goes away.
And Paul, you do cover some Florida specialists as well, right? So walk me through some of those names and how vulnerable they are here.
The two I cover are Heritage Insurance and Universal Insurance. Both of them have very large positions in Florida, but some diversification as well. They rely heavily upon reinsurance. They buy an enormous amount, something like 30+% of your premium in Florida will go to reinsurance costs. They'll have a limit loss, most likely, meaning that they'll full deduction on the reinsurance. And then with our fingers crossed, hopefully the damage is not that bad and it goes through the top. And that's essentially the limit for the losses that they will take. And it all get pushed out to the reinsurers on a global basis.
Paul, I'm curious, are there any areas in Florida that are already experiencing just record levels of insurance costs that are making it unattainable for residents in those areas?
Yeah, I mean, it's hard to find a place in Florida that isn't. I think my companies are telling me that they've raised rates cumulatively in the last 3 years about 100%. So, and I don't think there's any exceptions in Florida. It is a very unusual and highly stressed market with an enormous amount of rate increases, in part due to these storms that just don't seem to end. But there are other things in Florida that have made it, like litigation, a very expensive state to buy home insurance in, or really any property insurance.
Talk to me, Paul, just long term, what you think the insurance market looks like in Florida, because we've all seen the same headlines, the reports, Paul, what's described as sort of this exodus of big insurers from the state.
Yeah, I don't think the big insurers are coming back anytime soon. I think Florida will be left with specialists and who are heavily reliant on the reinsurance market. My guess is there'll be fewer of those over time. I think you'll have some concentration of the business in Florida. And I think it will be ultimately specialists in Florida who continue to dominate the market, if not more so. The big question is what happens underneath with the recent tort reform and potentially structural changes that hopefully help to reduce overall costs. That's a question mark that's particularly for Florida. It's a very unusual market.
It certainly is, Paul, and it's something that, my whole family is from Florida. They're in the area. I'm looking at our group chat right now on my screen and taking a look at their insurance costs, and the numbers are, I'm glad that I'm not a homeowner. Let's just leave it at that. But I'm curious about kind of the long-term impact of these extreme weather events, which you kind of just touched on, but if we keep having to rebuild, reinsure, go out to insurance companies to rebuild over and over and over again, where does that leave us long term? Like, how bad could this get?
Well, first of all, hopefully your family is all safe. But, this is ultimately a cost plus industry. And so as the storms continue to hit and become increasingly costly, you're just going to have increased costs that get pressed down to the consumer. There's really nothing you can do about that other than try to make some structural changes to reduce litigation, make the market more efficient. But it's just always going to be a costly state to having home insurance. And if you think that you're going to see more and more of these storms, that unfortunately just means you're going to pay more in costs over time.
Looking at your coverage universe, Paul, you've got a number of buys. Any names as we let you go here that you're especially bullish on, a strong buy?
Yeah, we're very bullish on all the personal lines writers. So companies like Kemper, Progressive, Allstate, putting the unique situation in Florida aside for a moment, this is probably the hardest market, meaning the highest price increases in auto and home on a national basis that we've ever seen. And I think that probably leads to good earnings for 2 or 3 more years for those companies in particular.
All right, Paul Newsome, we got to leave it there. Really appreciate you joining us. Thanks.
My pleasure. Thank you.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. And here are some of the trends we're going to be diving into. Another day, another record for the markets. Both the Dow and the S&P 500 closing at new highs as the Fed minutes showed FOMC members were split on how much to cut rates last month. We're diving into the trading trends of the day that's coming up next. Plus, the IPO market thawing out with KinderCare going public today as rates come down. We're looking at whether we can expect more companies to hit the public markets. And tomorrow's a big day on Wall Street. Not only do we have the CPI report, of course, but Tesla's robotaxi event is finally here. We've got everything you need to know. That's coming up. U.S. stocks close higher with the Dow and S&P 500 climbing to a record close. Here with more on the trading day takeaways is Yahoo Finance's very own Josh Schaefer. Josh.
Hey, Josh. Yeah, you know I love a record, so we're going to start there with records for the S&P 500 and Dow Jones Industrial Average. I'm just going to take a look at the market action that we saw throughout the day. So you see the Dow rising about 1% today. The S&P 500 was up about 0.7%, almost hitting 5,800 for the first time ever. What stuck out to me overall in the action, I want to look at the sectors because yes, tech led today, but it's not just tech leading this market right now. You had industrials and financials, XLI and XLF, closing at all-time highs. So you're continuing to see sort of that breadth in the market. I think perhaps the broadest question right now, Josh, as I just mentioned, we almost hit 5,800. Is what's going to keep taking us higher as we go throughout the year. That feels like a little bit of what the discussion is right now.
And when you talk to those very smart strategists, what do they think? The good times continue?
Yeah, it seems like that. So if you look here, if we go over a 2-year period right now, this is a look at the bull market for the S&P 500. It started almost exactly 2 years ago today. It was 2 years ago Saturday. And I've been asking strategists, okay, so we're about 60% up in 2 years. What do you see moving forward? They said we need to just see a lot more of what we've been seeing, that breadth that I just mentioned, and sort of this soft landing economic narrative continuing. Scott Kroner, Citi's lead equity strategist, told me, look, unless there's a shock, and a shock means we're not going to know it's coming, right? He said, if I look at what's on the table today, it's probably stocks chugging higher. It's if some sort of shock happens, maybe it's something that happens in the labor market, right? Maybe the Fed isn't exactly calibrated like they should be, as people have discussed. Maybe that's what it is. But maybe it's something in the Middle East, something we're not seeing. But until that shock happens, right now the economy's in a pretty solid spot and earnings are expected to grow. And so until that narrative changes, it's hard to argue that the bull market doesn't keep driving for us.
All right, Schaefer, bullet point number 2.
Yeah, I'm going to skip ahead a little bit here and show us all we got for the day. And we're going to look at bullet point 3 or bullet point 2 here. Case for the Fed rate cut in November builds, right? So this was post the Fed minutes this morning or this afternoon. That came out from the September meeting. What stuck out to some economists in that was we knew that Governor Bowman dissented on the decision, right? She had said, I want to cut 25. I don't agree with 50. When you read through the minutes, though, it said that some officials also agreed with that.
So it was a healthy debate. It was lively.
It was a healthy debate. There was more people debating than maybe it seemed in that press conference. And when you take a look at what that did to our CME Fed to a watch odds that we like to look at, more people now looking for maybe no cut in November, right? Because what a lot of the base case was for why they cut by 50 in that meeting, what officials were talking about, a weak labor market. Well, that was before last week's jobs report. They came in strong. So essentially, if we were really cutting because the labor market's weak, maybe narrative changed a little bit. And if people didn't want to cut by 50 in the last meeting, maybe they feel like 50 is enough and they already kind of did their November cut. That will be sort of the debate, I think, as we move forward here. Final takeaway, all eyes turn to inflation. So tomorrow we have that CPI print. We were just talking about the Fed. Obviously going to be big for that. And I want to take a look at this chart, Josh. This came out of the jobs report. This is wage growth, ticking back up in September to 4%. This is a key measure that economists watch because if we're making more money, we're going to accept higher prices and that can keep inflation higher. You can see we've been tracking lower pretty steadily for a while now. Trend's been up in the last 2 months. Economists say that makes this CPI report perhaps more important than we initially thought, putting a little bit more stress on what we're seeing from inflation now that we know the labor market's strong. If inflation's not falling as quickly as we thought, maybe that means, again, either the Fed doesn't cut or they cut less than we thought.
I mean, the last couple CPI prints, we were talking about this. I mean, they're always in focus, but this one tomorrow feels a little bit more front and center.
Yeah, no, it does. So the team at Bank of America was taking a look at the options market. You can kind of look at the implied move of the S&P 500. As of last week, it wasn't looking like much. Post-jobs report, it jumped. They now think we might see the biggest move in stocks on a CPI report since May. So it seems like it matters a little bit more focus. Hopefully it comes in soft, right? I think that's the clear read through here. Inflation, if it comes in higher than expected, that's usually not good for stocks. If it comes in line or lower, that's usually either unchanged for investors or perhaps a catalyst to keep moving markets higher.
All right, we'll find out soon enough. Joshua, thank you. Oil steadied in choppy trading Thursday as U.S. crude inventory swelled and traders monitored China's plans for fiscal policy. Prices moved off their lows the day after data from the U.S. government showed its crude stockpiles increased by 5.81 million barrels last week. That's a smaller buildup than the 11 million barrel gain an industry group projected on Tuesday. Joining us now with more on oil is Tamar Esner, Vectus Energy Partners Principal. Tamar, it's good to see you. So obviously, listen, investors are still focused tomorrow on geopolitical tensions, and I want to get to that. But if we put that aside tomorrow, you just look at the fundamentals of the market. I'm curious what you see now and what you're forecasting ahead.
Fundamentals are bearish, and seasonally, this is a weak time of year. We've finished the summer peak demand, and we're in the shoulder season where refineries are in maintenance mode, getting ready for the winter grade. So there isn't as much demand right now. And what we're seeing is that OPEC has a lot of capacity that they have kept offline. So they've artificially lifted up prices. And we know that they want, at some point, probably sooner rather than later, to bring some of those supplies back to market to monetize those barrels. At the same time, countries outside of OPEC, mainly in North America, are growing production. And that production growth is largely independent of price because they are long cycle investments. At the same time, you talked about China demand is weakening. Other parts of the economy and globally are weakening. The U.S. is holding up really well, but with China as the main demand engine, that's a problematic story for oil.
And so tomorrow, so if I look at Brent, 76, 64, what's your forecast, let's say 6 months from now, 12 months from now?
Well, there's a huge range depending on what happens. Obviously, geopolitical pressures could put a lot of upward movement on prices. Our base case is that it just adds to volatility rather than sustained upward support. So we think we could see, revisit price action that we had last week, where you get big bumps and then those prices are then soon after deflated. But obviously, a lot of it depends on what actually happens with the Israeli response to Iran's attack, and probably even more important is how does Iran respond counter to that, because Iran potentially could close the Straits of Hormuz. So obviously, that would be a real upward and movement to oil prices. And on the fundamental side, we're really looking to see what happens with China. Big stimulus package, but not really clear that that's actually going to stimulate oil demand. We see that as a secular trend, their economy is getting more and more independent of oil. So even if they are able to boost economic growth, it doesn't actually necessarily translate into oil demand growth. So we're sort of weighing that outcome. If OPEC goes ahead and ends up with a price war at some point later on next year, we could see prices, to answer your question more directly, go down, closer into the 60s and 50s, even if that's what it takes to curtail supplies. And upside is really what happens mainly geopolitically, because as I said, fundamental story doesn't look that great.
So and on geopolitics, let's say tomorrow, Israel does hit Iran's energy facilities, and reports suggest that's still very much on the table as a possibility. You would expect the reaction in the oil markets to be what?
Well, it depends on what they hit. I think the market's most concerned about hitting their export facilities. Almost 2 million barrels a day come out of Karg Island. It's a sort of concentrated target. If that happens, I think you could easily see $5, $10 in the price of oil. But Saudi Arabia alone can easily compensate for any lost Iranian exports. That's how much spare capacity there is in the market. The big concern is after that, if Iran does a counterattack and includes Saudi Arabia in the response, and they go after Saudi oil facilities. There is some precedent for that, with the Houthis doing an attack on Saudi oil installations in 2019, Houthis being, a militia group of Iran. So there's some precedent. Our base case, though, is that Israel doesn't want to attack the oil installations. It's not real. I mean, I know it's been discussed, but I don't think it really materially advances their near-term security interests. So I don't think that that's what they're going to do. I think they'll go after more military and command and control assets. And at the same time, our base case is that Iran doesn't want to disrupt oil flows either, because that's not in their interest to do so. So obviously, every day that this conflict is not resolved, we see greater risks of these tail risk events actually happening and miscalculation and all of that. But again, our base case is that oil remains generally unscathed.
And just turning here back filing tomorrow here to the U.S., I mean, election just weeks out now. How do you factor that election into your forecast?
Well, I think that it's really difficult to do so because, candidates say a lot of things, and to some extent, some of them have, Kamala Harris has said in the past that she's anti-fracking. She's recently come out against that. Obviously, if there were a ban on fracking, that would be tremendously bullish for prices. It's just really difficult to game out because it's impossible to know what policies would actually be implemented. In general, we've seen that Democratic administrations, are actually very supportive for the oil industry because they do a bit to curtail access to drilling. I, by contrast, don't think that the drill baby drill approach of Donald Trump will actually lead to more production in the U.S. So, I guess the main issue that I'd be focused on is if Donald Trump is elected and he targets Iranian oil from a sanctions perspective, he's done that in the past, would that take supplies offline? I don't really think that it would, but that's kind of like the key most near-term risk that we see. Otherwise, these are bigger, longer-term issues that I don't think have a direct tradable headline, depending on who wins the election.
A lot of big, complex cross currents there. Tamar, thank you so much for joining this show and helping us think through it. Appreciate it.
Thank you.
As oil prices have been falling, shares of Science Applications International Corporation, or SAIC, have risen 30% since the Middle East conflict began, and investors are paying attention. Our Rochelle Akufo got to know CEO Tony Towns-Whitley as part of Yahoo Finance's Lead This Way series, and Rochelle joins me now. Rochelle.
Hey, good to see you, Josh. So yes, I got some great access to SAIC CEO Tony Towns-Whitley for this upcoming episode of Lead This Way. Now, Towns-Whitley brings decades of leadership experience in tech and artificial intelligence, including as a former Microsoft executive, to this $7 billion company. So think of SAIC as the science and engineering that really gets integrated into military, national security, and government missions, making them more efficient and, most importantly, more secure. Here's a sneak peek. When you first came into the role as CEO here, the Israel-Hamas conflict kicked off. Already there was ongoing conflict between Russia and Ukraine. What does that do for the transition picture as a CEO coming in?
Well, when you walk into a company like SAIC that's right in the core of national defense, first thing is to meet this and support your customer. It's the first place your mind goes. So as soon as that conflict was communicated, SAIC had teams on the ground supporting customers that were providing capabilities there. Some of that operates in very open and understandable ways. So think about the decision analytics. You're in the middle of a global conflict. What data is flowing? How can that data be shared, not only with the US forces, but multiple coalition forces? One of the things we specialize in is what we call multi-level security. It sounds very techy and cool. What it really means is the ability to integrate data and provide data at every classification level.
Now, 75% of SAIC's work is in national security and defense, with the rest being in the civilian space. And I got to experience some of the latest real use cases of operational AI that SAIC is testing before they're rolled out to the public. So be sure to watch the full episode, because it really is a full experience when it comes to the work that SAIC does, especially with AI. So looking forward to that.
Awesome. Rochelle, thank you so much. Appreciate it. Coming up, KinderCare Learning shares jumped today after its IPO, but what's ahead for the initial public offering market in 2025? More asking for a trend right on the other side. KinderCare goes public on the New York Stock Exchange, the child care provider debuting at its anticipated pricing of $24 per share. For more on this milestone, let's get to Yahoo Finance's Brooke DePalma. Brooke.
Good afternoon, Josh. That's right. Shares close at $26.13. Now, that is a little bit higher than the initial price of $24. And CEO Paul Thompson told Yahoo Finance this morning that the company is really pleased with the IPO price, but it's really focused on the long-term growth ahead for the organization. Now, most of the capital raised today will be used to pay down debt that the company currently has, but this does give investors a second option here when it comes to investing in daycare. Its competitor, Bright Horizons Family Solutions, is having quite the year. It's up more than 40% year to date, and it's benefiting from three big waves here. Daycare is doing well post-COVID. You also have this concept of backup care, that concept of dropping off your children at a random time in a chance of an emergency where you have nobody to take care of your children. And also teacher turnover is coming down. And so those are three benefits that's really impacting the daycare business as well. But of course, KinderCare coming in a time where Bright Horizons has been public.
And we talked to the CEO about childcare affordability as an issue. What did he have to say about that?
Yeah, quite an issue. Daycare prices are up more than 6% year over year, according to the latest CPI print. Of course, we'll get another look at the CPI print on Thursday morning. But when I asked the CEO of KinderCare earlier today, he basically said that they have a spread awareness about what exactly parents, what exactly guardians are getting for the amount that they're paying. Take a listen to this.
It's important that it's about education within the center, about having the right teachers in the classroom. Health and safety is so important to parents. So really emphasizing quality and experience and engagement, emotional connection within the classroom is how we think about what we owe the parents and how we show up very well for them.
But Josh, it's important to realize that the average cost per child care is nearly $10,000. And so it really is, you have to get the best bang for your buck here. But many sources that I have spoken to have said that this really does impact the local economy. If parents are able to put their children in daycare, they're then able to be part of that local workforce. And ultimately, if a parent steps out of the workforce for said a few years, then when they get back in, they'll be at a lower income level, and they'll also miss out all those years that they could have gained a different skill set while they were learning how to take care of their child. And so it's really be interesting to watch to see how these for-profit companies really make their way into the daycare, education, and so on in the U.S.
All right, Brooke, thank you. Important story. Appreciate it. Child care provider KinderCare is one of the 9 companies pricing their IPOs this week. So far this year, market has seen proceeds reaching roughly $35 billion. It's up about 60% from last year, according to Bloomberg. But our next guest sees IPO market trouble in the coming months with a spoonful of uncertainty ahead. Greg Martin, Rainmaker Securities Managing Director, joins us now to discuss. Greg, great to see you in studio.
Good to see you. Good to be here.
So we're rounding out 2024. As we look ahead in 2025, give me a big picture view. I mean, how much activity do you expect to see?
Yeah, well, as you mentioned, it has been up this year after a couple dismal years in 22 and 23. The election is a big wet blanket, particularly on the tech sector, which I cover. So despite the fact that we've had a really strong S&P 500, which has really been more about 7 key stocks, although as we heard earlier, it's a little more broad-based. I think we will start to see the big backlog that we have waiting for the uncertainty to leave. The political uncertainty we discussed, the rate uncertainty. So even though we had a rate decline, we're not sure whether we're going to have another decline or whether we're going to hold rates constant. We have an inflation print. We have the geopolitical uncertainty. So there's still a lot of uncertainty, and that to me is the reason the IPO market hasn't reopened in the fashion that we would have expected by now. But that said, I do think we have a good pipeline of companies for early 2025.
We were talking to a venture investor on the show recently, Greg, and I asked him the same question. On tech companies, he didn't sound very optimistic or confident that we'd see it. And I asked him why. One reason he gave is he said, talking about tech companies, and get your take on this, he said, so many of them have raised just so much money. And he really thought you weren't going to see a lot of activity for 12, 24 months because he thought they've raised so much. Why not, if you're an entrepreneur founder, sit back, focus on your business, grow, don't go public, don't get distracted. You got plenty of money.
That's right.
What do you make of that argument?
I mean, the IPO-able companies, so you think of the big behemoths in tech, think of Stripe, you think of Databricks, you think of SpaceX, you think of ByteDance, you think of OpenAI most recently. they have had almost unlimited access to capital. They provided a lot of liquidity for their employees and investors. They've raised rounds of capital when they needed it in the multi-billions. We just saw OpenAI raising a significant amount of capital this week. So they don't need to go public. I think for a good subset of those, being public is kind of a luxury that when the markets are buoyant and when they see multiple expansion and get comfortable with some of the uncertainty we talked about, maybe they will go public. But why have the headache of being a public company when you get what you need as a private company? So it will be interesting. I do believe some subset of those will go public when the markets are really frothy. But for now, they're happy being a private company and they have no need to be a public company.
And what does it mean for those employees of those companies, Greg? I mean, they have life expenses like everybody, right? Mortgages, the kid needs braces. What happens to them?
You know, so we have seen companies employ annual tender secondary process. So, you know, we just saw SpaceX, which does annual tender offers, and oftentimes as a component of some of these rounds that we see with OpenAI. We saw Databricks do a tender offer as well. So there are company-sponsored tender offers, and at Rainmaker Securities, we also operate one of the largest secondary trading platforms. So we see a good amount of liquidity happening in the private secondary markets where there are investors who want to access these companies, and there are people that have family real-time needs, buying a home, private school, whatever it might be. And so there is liquidity outside of the public markets in these private secondary markets that firms like ours facilitate.
Do you think in this environment, or even in kind of the near term, is there a kind of company, Greg, a kind of business model that you think would go public and have a greater chance of, you know, a good, solid showing?
You know, there's below the set of companies that I just mentioned, the companies that maybe don't have the same level of access to capital in the private markets, but are also good predictable earning types companies that will benefit from lower interest rates where there might be higher multiples. I think those are the set of companies that I would expect to go public. We had a report, you know, unconfirmed by the company last week that Chime, for example, has hired bankers to go public. That's something that we expect to happen in early 2025. They haven't had the same level of liquidity, you know, via company tenders as other people have. Maybe they don't have the same access to capital in the private markets as some of the other companies I mentioned. So I think that subset of companies that are really strong companies that would lend themselves to being a public company, I would see those as being the next wave of IPOs.
You're out there in California, you're talking to these entrepreneurs, technologists, investors. Greg, is the excitement over AI as red hot as when I talked to you 12 months ago?
The excitement over AI is amazingly red hot. I mean, obviously, we've seen the success of NVIDIA. We saw Oracle with their big announcement. We see OpenAI at a $157 billion valuation. This is a company.
Remarkable.
It's unbelievable. You know,
it's Goldman Sachs, by the way.
Right, exactly.
Yeah.
It's right. And it's, you know, we see CoreWeave, we see some of these infrastructure providers, Lambda Labs. So I would say the AI hype is still strong. I think there's always in the back of their minds of when is the music going to stop? When do the numbers need to fit the hype? You know, but right now there's almost unlimited demand for, I mean, we see it with NVIDIA for AI infrastructure, but at some point, is there not enough revenue associated with the applications that they support that people will start questioning the hype a little bit?
Yeah, we'll see. Greg, great to have you in studio. Thanks for joining us.
Hey, great to be here. Thank you.
And coming up, it's What to Watch for Thursday. I'm going to tell you everything you need to know to kickstart your trading day. Stick around. We're asking for a trend on the other side. Time now for What to Watch. Thursday, October 10th. The day is finally upon us. Tesla's highly anticipated robotaxi event is tomorrow night. It's being considered a make or break moment for CEO Elon Musk as the stock has struggled this year amid cooling expectations for EV growth. Investors will keep a close eye on the event to see the prototype and how the company can reach its lofty valuation expectations for the business. And on the economic front, new monthly CPI data for September, that's the Consumer Price Index, coming out at 8:30 a.m. Eastern. Economists forecasting both core CPI and overall CPI growth to slow compared to the previous month, and the data could have implications, of course, for the Fed's next policy move. Moving over to housing, we're going to be getting new weekly mortgage rate data tomorrow afternoon from Freddie Mac. After declining 5 out of 6 weeks, the 30-year fix ticked up to 6.12% last week. Now, on the earnings front, Delta Airlines and Domino's Pizza both reporting third quarter earnings tomorrow morning. Over to jobs, more initial jobless claims data is coming out in the morning. The number of claims expected to increase to 230,000. And finally, more commentary from Fed officials tomorrow morning is coming after today's FOMC minutes for September show that several Fed officials supported a 25 basis point cut in September. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.